equity market exposure? Do I stick with the winners, or do I take the risk and go where it's cheap?
The issue is that in this market, which is very momentum-driven and high beta-driven, what is expensive is getting more and more expensive, very crowded, very leveraged. And we have more and more difficulties to reconcile valuation, in particular in some parts of Western markets, so US, Europe. And we find more and more value actually in Asia at large. Sorry for the previous speaker, but China is very cheap, and there are some very nice companies there, which are totally overlooked, and that we start really to like a lot actually, because you pay a third of the average price of the US, and you get a nice economic prospect, a good earning momentum, nice innovation stream. And China is gaining market shares actually everywhere. So we, on a medium long-term basis, we think it would be a big mistake to not to have China in portfolios.
Interesting, because you're still maintaining a pretty defensive stance.
Yes.
And saying that this U.S. and Europe, record equity rally is gone too a bit far. But you're saying China could be that alternative now.
China, South Korea, Japan, but a little bit less so because of the big pickup in prices in the last year or so.
Okay.
India is expensive, but for a good reason. So we continue to like it, and South Asia as well. So Indonesia, Thailand. So I would say Asia at large. It's a big overweight for us. So we are more underweight. US, except small mid-cap, utilities, and some names which are cheap in US. But on average, the CAPI-weighted indexes are quite pricey.
How do you sell the idea, though? It's a good idea. How do you sell that to your clients? Because if we followed your advice, we would have lost some money.
Absolutely.
Quite a pain trade for you.
You're right, absolutely. Absolutely. So we need to be humble first, because it's to time it's very difficult. Today, I have to say that with 90% of our clients, it's not yet something they want to hear. So they want to hear India, they want to hear Japan, South Korea. It starts, but China is still something that they don't want to go to. So
what still concerns them, you think?
It's a mixture of not understanding very well the policy at play, still some fears about real estate, and some overall fears of sanctions potentially coming. So when you are a US or UK-based investor, you don't want to be trapped there with sanctions. So there is still this narrative around saying finally the risk-reward, the tail risk is too high to take it.
Right. Which sectors do you have the highest degree of confidence on when you look at China, for example? What's the easiest sell you could make?
Yeah. So it's there are two main sectors that we like. First one is some very deep technology, so supercomputing, some biotechnology that are where China is really taking the lead. Renewable energy as well. The innovation in China is huge, and people don't really realize it in US or Europe, and the valuations are pretty decent. And then as well some very traditional sectors like Mutai, the white wine, or this kind of.
We've heard of it.
Yeah. So some I would say some more classical sectors, but where China is making. When we see a pickup in consumption, in quality, and as well valuations are pretty interesting. There are also some, of course, electrical vehicles builders, some sneakers builders, makers, etc. When you go to more traditional things, you can find some very good companies actually. So.
What separates? We just had UBS on, and he was trying to look for parallels between what we saw in China back in 2015, which seems like a peak, versus something that was sustainable. What makes this look like something that is a longer term or medium term recovery now, versus maybe just a false start?
In fact, when you look at the GDP growth breakdown in China, it has changed a lot in 4 or 5 years. So China used to be driven by real estate and by cheap exports. Now it is driven by local consumption of better quality, some serious investments in technology and higher quality production, and energy transition as well. So China of today has little to do with China of 5 or 10 years ago, And that's why we believe the GDP growth is much healthier, and it's more for medium long term will produce some value for the country, but as well for shareholders. So that's why we like this new growth, and the shift has been very significant. I don't believe there is any other country in the world which has been able to shift its economy in 5 years' time like this. It's quite impressive.
In terms of what that means for, say, funds or mandates and specific strategies, because something that's come up is an EM ex-China strategy, for example, right? So because if I add China to the EM, then the returns go away.
Yes.
When you have it separately, then China kind of makes sense.
Yep.
Do you believe that makes commercial sense, and do you believe that makes investment sense?
Actually, we launched recently some emerging ex-China funds because of the demand of our clients. First, because they wanted not to have China, but then we have a few clients who wants to have this as well, to be overweight China, which is something interesting, and so to pilot and to be more agile regarding China exposure. So going forward, I think we will have more and more China as a specific allocation pillar with overweight or underweight, but totally separated from other countries. So it will live its own life, if I would say.
Last question.
Yeah.
Last February, you told our colleagues back in Europe that global equity markets are about 20% overpriced.
Yes.
What's your assessment now? Where are we now?
The same.
Same?
I'm a little stubborn. No, I mean, when you do the math the other way around, we think, I mean, current markets in the West are incorporating a kind of blue sky scenario, or a very perfect scenario, which may happen.
Yeah.
But it is quite likely that it will not happen exactly like this. So when we do the math the other way around, starting from earnings, company by company, it's very difficult to reconcile the price-earning ratio and the earning growth baked into the market. So that's why we are, markets are quite expensive still.
Okay, well, sorry, can I just sneak in one last question?
Sure.
Cash. Everyone's still going in cash. $6 trillion in cash strategies. Are they wrong?
6 trillion is a big amount of money, but finally it's just 3 mega cap in terms of market cap. You see my point? So
now you put it that way.
so I mean, and cash is at last yielding something still. So I mean, cash is for us is now one allocation pillar amongst others. So we allocate to cash, I would say 5% of our funds.